All right, good afternoon, everyone. Welcome to today's webinar, How to Swing Trade Breakout Patterns. This is a fun topic. I always love talking about and teaching different types of breakout chart patterns. We're going to be talking about continuation patterns today. Stephen NJ says all good and hello. That saves me, I guess. Just a quick sound check. I want to thank everybody joining us via YouTube as well. So welcome everybody, good afternoon. Hope you guys are ready for a really good webinar. My name is Jerry D'Ambrosio. I'm the manager of educational content here with VectorVest. Been with the company now, 2006, so 16 years, just 16 years in March. And I'm just one part of our fantastic education department. Our number one goal is to make you guys better traders, better investors. The education team, and I was talking about this the other day, we've really morphed into so much more than what we used to be when I first started with VectorVest. When I first started, the education department focused mainly on the VectorVest program. Okay, we've really morphed into just a lot more. Not only teaching you the VectorVest program, but also teaching you different techniques, different trading techniques, different investment techniques. We have a whole options department within our education team as well. Just a great team. I also want to welcome and thank John Marabu. He is in the background. He is the fourth gentleman over to your left. He'll be answering any questions that you guys have along the way. I got a ton of content to cover here, so I'm going to try to answer some questions along the way. But if you do have one, I'm not able to answer it, John will shoot you an answer in there, and I'll try to save some time at the very end to answer some other more common questions as well. So we are going to be together for an hour. So what I want you guys to do, I hope you can, stick with me to the very end. If you do, and again, right about 5:30 Eastern time, we'll be wrapping things up. Just a few minutes before that, just remind me, say, hey, Jerry, don't forget the slides. I want to give you a copy of today's slides. As long as you stick with me to the end. I'll put the PDF in the handout section of your GoToMeeting control panel, and we'll go from there. All right, let's see, no other questions? Thank you, Luis. The baby is good. My son will be 3 in 3 days. My 8-month-old will be 8 months old in 4 days. So family's good. I appreciate you asking. So like I said earlier, we're going to be talking about continuation patterns today, continuation chart patterns. There are a couple of different types of patterns that we teach, different types of technical chart patterns that we teach at VectorVest, continuation patterns, reversal patterns, among others. So today we're going to teach you guys a few different continuation chart patterns, and it says continuation chart patterns can be sideways or counter trend price action that represents a pause in the current trend move. Now, you may have recognized this behavior, this phenomenon before, but didn't necessarily know what it was or how to trade it, what it's called. And we all see nice up moves followed by a pause, right? Little profit taking, little bit of consolidation before the next leg up. I'm going to show you guys how to recognize that situation and how to trade it. This is called how to trade breakout patterns, right? So we have to wait for the breakout. We don't trade the consolidation period that follows an up move. We don't trade during that period. We don't take the trade during that period. We wait for a breakout. And there are certain things that you want to pay attention to and be aware of to help you understand if it's a true breakout or not. It says the next price move is usually in the same direction as the trend before the pattern. So here we're going to not only teach you how to recognize the pattern, how to trade the pattern, wait for the breakout. If you do wait for the breakout and then take the trade, all right, here's a couple of things that are very important, right? All right, if you take the trade, where's your stop loss? The stop loss is particular to the pattern itself. There's a baked in initial exit level, and there's also a baked in profit objective, profit target. And that goes for flags and triangles as well. And those are the two continuation patterns that I'm going to go through here today. bull flags, and triangle patterns. Each pattern has its own very unique initial stop loss. Well, first of all, breakout. You have to know when the breakout occurs. You have to know what to look for in terms of follow through the next day, because you don't actually trade the breakout. The breakout is your trigger. The breakout is telling you, okay, here's where you're going to look to take the trade the following day if you get confirmation. The breakout's important. Closing breakout, a closing price above your breakout level, is your trigger. What's telling you to enter the trade. The following day is very important. You got to wait for confirmation the following day, and that's when you actually take the trade. And when you do, you're going to understand where you exit at a loss if the trade goes the other way, or where to take profits if the trade goes your way. Okay? So flag pattern characteristics. They appear in strong uptrends, in really strong up moves. So we look for a sharp up move followed by either a down sloping or sideways price behavior on light volume. And that sharp up move prior to the downward sloping or sideways consolidation period needs to be on really strong volume. There needs to be conviction in that strong up move prior to the consolidation period. Okay? The pattern completes within about 1 to 3 weeks. Okay, 1 to 3 weeks. And the measured move is the length of the flagpole. So what is the measured move? The measured move is where you should expect price to rise to after it breaks out of the consolidation period. And that is generally, again, it's not to the penny, but it's a general length, and that length is the flagpole. Okay, so this is called a bull flag pattern. It consists of, I guess, two lines or two situations. The first is that strong up move, and the second is the down sloping or sideways consolidation period. So that the length of the strong up move is what you would add to the closing price of the breakout candle. You can measure the length of the flagpole, right? I'm going to show you some examples here where you draw a line, you draw a literal line from the base of the flagpole to the top of the flagpole, and that price difference there from the top of it to the bottom of it is what you add to the closing price of the breakout candle. That's your measured move. Your initial stop loss is going to be the low of the flag formation. All right, and so the flag is the downward sloping or sideways consolidation period that follows the pole, the flag pole itself. Okay, so here's a diagram. We're going to look at a lot of charts here in a moment, but just here's a diagram of what we're talking about. It's just again, a diagram, not necessarily price exact, but there's your strong up move, right? There's your strong up move. You had higher highs and higher lows, and then you get this period of a consolidation following that strong up move. In this case, it's a downward sloping consolidation period. So during that consolidation period, well, first off here, I would draw my flagpole probably from this level here. Whoops, that's not a very straight line, but that's my flagpole. I would draw it from here, the breakout here to the top of the the high there. That would be my flagpole. So I would measure. What price is that? I'd subtract that price from that price. That would give me the measured move, and I'd add it to the closing price of the breakout candle. Clearly, that is the breakout day, right? So you get this consolidation period where, you're channeling, it's a falling channel, but during that period, you can recognize and draw lines to connect lower lows and lower highs. It's a downward sloping channel. Okay, so those lines just continue, and that flag continues until you get the breakout, and that breakout occurs on high volume. You need it for it to occur on high volume. Okay, so you wait for the breakout, You don't trade on the breakout day, but you wait for price to close above that downward sloping upper trend line, and then you take the trade the following day on confirmation. Okay? If you take the trade the following day on confirmation, your initial stop loss is the low of the consolidation period. The low of it. So you have a couple of touches here at this level here, and right below that is where you would set your initial stop loss if you do take the trade and the trade goes the other way. Now the measured move is the length of the flagpole. So you can almost just draw it again. That's basically the same length, right? So you draw it, or you measure it, excuse me. Take that price, subtract that price, you add the difference to the closing price of the breakout candle, and that is your measured move and your initial profit target. Okay? All right. Here's an example. We're going to look at a real-time chart here in a moment, guys. These are just slides. I wanted to give you these slides so they can print it out. So Sherilyn says, the purchase date, does it have to close above the breakout? No, it has to go above the breakout. So the breakout is your closing breakout. Then you enter the following day if price moves higher than the close of the breakout candle. It doesn't have to, again, close above your breakout candle. The following day, 9:45, 10 o'clock in the morning is the earliest you'll look to take the trade. If price goes above the closing price of the breakout candle, that's where you enter. And so here's an example here. So here's zebra. Here's your flagpole. Okay, strong up move, right? Look at that volume. Higher and higher volume pretty much each day during that up move. Okay, then you get a period of consolidation, right? You get some profit taking. It's not a mass exodus because you get this little rally here that didn't result in a new high, but we could see price trading in a very narrow channel here for a couple of weeks. That consolidation period, this one actually happens to be a downward sloping consolidation period, is occurring on what? Lower volume, right? Lower volume. So we got our breakout day, right? We got our breakout day. We have our close above the upper trend line. Look at that volume on that day as well. Good volume on that day. All right, so that's our trigger. We're expecting a continuation. The stock price did on the following day rise above the close of the breakout candle, so you did take the trade that day. That day right there. Right there, you took the trade. Stop loss is the low of the consolidation period. So where's the low of the consolidation period? Is it here? No. It's right here. So that's where you would put your initial stop loss. Okay? You measure the length of the flagpole. So you take that price, which in this case it's almost $250 even. You take that price, which is about 200, we'll call it 210 bucks. So that's $40, right? 40 bucks. You add 40 bucks to the closing price of the breakout candle, maybe at about 241 or so. So 280 would be your initial profit target. 280 would be your initial profit target. Just erase these lines. Okay, and you could see we didn't quite get there. We got to 260 before some hesitation. Okay, but there was a nice opportunity to make some profit. So let me say this. If you don't reach your profit target, right, you don't get to 280. Are you going to leave your stop loss all the way down here and let price fall all the way back to 231? I hope not. All right, so you had a nice opportunity for some profits. Was that a nice breakout and continuation pattern? Absolutely. Okay. Okay, John is asking, how do you know the consolidation period happened on the 12th candle instead of the 6th candle? Well, number one, okay, that candle there, was it on high volume? It was not. and it didn't break out above really any consolidation period. So I'm drawing these lines that connect these two highs here. We didn't break out above that line, did we? We didn't. And even if you argue that we did, not you, John, anybody, it didn't happen on really high volume. That's the key. That's the key here. The breakout has to be a strong one on really high volume. Okay. So here's AMD. So here's your strong up move, new high. I don't know, 1, 2, 3, 4, 5, 6, 7 days in a row the stock went up. Look at that volume, really strong volume there. Okay. Then you get this, couple of week period of consolidation. Look at the volume, generally overall, right, a little bit lower than average. We don't really have a breakout here, but there's your breakout, very clear. Okay, very clear breakout. Look at the volume on that day, and there's your trade. Okay, so there's the breakout, the closing price. The stock did go a little bit higher than that close. The next day, it also did the following day. So, confirmation doesn't necessarily have to happen the very next day. You give it another day or so. If price does rise above the close of the breakout candle, there's your entry. So either the following day or the next day, you did enter the trade. The low of the consolidation period is all the way down here, isn't it? So that's where you would set your initial stop loss. So you might, and what you should be doing here, incidentally, is calculating how big of a loss that may be, right? Because it looks like that could be a pretty significant loss. So we're looking at about 40, it's almost 43, that's 6. That's greater than a 10% loss. So you have to adjust your position size accordingly. Because if you're trying to dollar weight your portfolio, put the same amount of money into each position, what you don't want to do is risk any more than 1 to 2% of your overall portfolio value on any one of those positions. So if this exceeds that, if the stop loss here, which is where it needs to be, okay, it can't just be where you want it to be. That's the thing I love about these patterns is you don't have to guess, or you don't have to place the stop loss yourself where you think it should be. It's already it's the bottom of the consolidation period. That's the textbook exit criteria for trading a bull flag pattern. So it's already baked in. So it's in that level there. So if you calculate, okay, what's my risk here, and it's greater than 1 to 2% of your overall portfolio value, you just adjust your position size. You don't put as much money into the trade as you normally would. You adjust it so that if you do, if the trade does go the other way and you do get stopped out at your initial stop loss, it doesn't exceed 1 to 2% of your overall portfolio. Okay? So there's your initial stop loss. The measured move is what you would add to the closing price of the breakout candle. So you take this price, you subtract it from that price, you add the difference to the closing price of the breakout candle, and there's where your initial profit target should be. Now, I know you don't see what happens, right? If we're looking at the hard right edge as of the breakout, you don't know what price is going to do afterwards, but you still can add the difference between this price and this price to the closing price of the breakout candle to set an initial stop loss. Okay, now I'm drawing it here because we obviously can see what happened after the breakout, but you can't see that. And I'm going to show you guys a real life example a trade that I actually took recently, added it to our swing trading coaching group portfolio, a bull flag breakout just recently. So you'll get a sense. This is obviously a historical example. I want you to understand what to look for. You look for a strong up move on high volume, followed by a period of consolidation. It could be downsloping, it could be sideways on lower volume, then a breakout on higher volume. Understand where the stop loss level is and where your profit objective should be. These are historical examples, but I'll show you a few real-time examples in a moment. Okay? All right, next one. All right, here's REGN, Regeneron, right? In the news not too long ago. Now we're looking at an older example, but here's your continuation pattern. So you had this down move here. The stock was sloping upward, at the end of 2019, beginning of 2020. Then you had this down move, but the sharp up move that followed resulted in a new high. That up move was accompanied by high volume. And then you have here, in this case, it's not a downward sloping consolidation period. It's about a week of a sideways moving channel on pretty low volume. Again, you're not trading any bar or any day in between or within that consolidation period. You wait for the breakout. Strong breakout, undeniable breakout. Okay? On really strong volume that day. Undeniable breakout. Okay? So the following day you get confirmation, you take the trade. Your initial stop loss is the low of the consolidation period. It has to be, that's where it's supposed to be. Okay? You calculate what your max loss could potentially be on this trade and adjust your position size accordingly. Okay? This is the length of the flagpole from the base to the top of the, right when the price began to consolidate. You take that price, you subtract it from that price, you add it to the closing price of the breakout candle, and there's your initial profit target. And I emphasize and say initial because that is where you should take action, meaning you can close the entire position if you want to, or you can just take half off, let the rest run, raise your stop higher and higher as the price continues to run, and lock in and protect the second half of the trade by keeping a tight stop on the rest. Terry is asking a good question. Unfortunately, it's not possible. How could we create a search in the Unisearch to find some of these patterns? I haven't figured out a way to do it. This is a cherry picking approach and a chart reading approach. So unfortunately, no way to create a search. We don't have a search in the VectorVest program to find these patterns. Okay. Yeah, so Luis is asking, when scanning for these patterns, now visually scanning, right, not using a scan or a search, do you consider the overall market first? Always. Always considering the overall market first. This is a bullish pattern, right? So we want the market to be in a bullish scenario. The MTI above 1 is kind of ideal. Now, there's no particular market timing signal that you should use necessarily. Just make sure the market is rising in one manner or the other. Okay, so here's another example. Here's ODFL. Here's your flagpole, really strong volume. Downward sloping consolidation period lasting for a couple of weeks on low volume. Now we did kind of get a breakout on this day, right? Kind of got a closing breakout. How was the volume? Was it, we're looking at a real strong volume day, real strong conviction behind that breakout? I don't think so. First, not only that, but you didn't get followed through the next day. So there's no, and then a lot of times you'll see that. A fake breakout or a weak breakout followed by a down day the next day. This is what we look for. Look at that big breakout here. Huge breakout. Pretty good volume on that day. Okay. But a clear breakout, undeniable. Follow through the next day. You take the trade. You set your initial stop loss right below the low of the consolidation period. Okay. You take the bottom, the base of the flagpole, take that price, subtract it from the top of the flagpole. You add it to the closing price of the breakout candle, and there's your measured move. Where again, do something, take action. Now what I see here, and I see a very weak end of the up move. Can you guys see it? Why am I saying that? Why do I say that at the very end of that up move, I'm seeing weakness? Not only price is kind of faltering a little bit, but look at the volume. Look at the volume dry up during this period. Yeah, Eugenia said no volume. Look at the volume drying up during this period. Price is still going up a little bit, but that's a warning signal for me for sure. You have a doji here, you have follow through the next day, you're out. Okay, you're out of the trade for sure. All right. Next, we're going to talk about a triangle pattern. So that was a bull flag, and I'll show you guys a bull flag example in a moment, a real-time example, okay? But let's move on to triangles. Any questions on bull flags? I had a couple here. Yeah, no searches. Colin says, when you don't reach your target, what determines your stop? That's a good question. Now, a general rule of thumb, if you make at least 10% on the trade, okay, and your initial profit target isn't reached, don't lose more than half of that. Don't lose more than 5% of it. So that's a nice rule of thumb to follow. Okay, bearish candlestick formations as well. So if, maybe the flagpole was rather long, right? So you added a nice chunk to the closing price of the breakout candle. Okay, and maybe your initial profit target is like 25% away. All right, well, that would be a great trade. If we got all the way there, that'd be a great trade. But if you don't get all the way there, you make at least 10%, don't lose less than half of it. Don't lose more than half of that. Or maybe you're up 15%, maybe you're up a little bit more, but you don't quite reach your profit target. Look for bearish candlestick reversal patterns. Right, you're likely in an overbought situation at that point. Yeah, you'd want to get to your initial profit target, but if you don't, and you're entering into an overbought situation, maybe stochastics is above 20, and you got a nice 15, I don't know, 17% gain on the trade, look for a reversal signal. I think that's another nice philosophy or strategy to use. Okay. No, you cannot have the flag sloping upward. Okay. We're looking at end of day data, Joe. So time frame, it's 3 to 6 months, right? You're looking for more recent. You don't have to look for at a whole year if you're looking at the hard right edge to look for breakout pattern. 3-6 months, you get an idea of the most recent, intermediate, shorter term trend of the stock. So I think the time frame 3 to 6 months, and we're using end of day data here. Okay, so we'll talk about triangles next. I love triangle patterns. There's a couple of different triangle patterns. There's symmetrical triangle, otherwise known as a wedge. You guys might be familiar with that terminology. We've kind of referenced wedges before in our daily color guard reports. It's just a symmetrical triangle. I mean, I can fumble around and show you guys here just quick. Here's what a symmetrical triangle looks like, right? Consolidation period where you're seeing higher lows and lower highs. You can draw those lines. That creates that symmetrical triangle. There's a descending triangle, which looks like this, where you have this level of support, but lower highs are being established. That's a descending triangle. Okay, we're going to talk about an ascending triangle today, which is potentially a bullish pattern. So triangle characteristics are when price consolidations that begin to narrow in a sloping direction. So again, it can either be a downslope, kind of both, right? A downslope and an upslope, forming a wedge pattern, or it can be an upward sloping direction. Volume is important with these patterns. I emphasize how important volume is with flag patterns, right? When you observe the flag pole, the sharp up move, it needs to be accompanied by high volume, and the consolidation period that follows needs to be accompanied by lower volume, weakening volume. Same thing here. Volume decreases during the formation and increases on the breakout. And the measuring objective is the distance from the top to the bottom of the triangle. You have a measuring objective here as well. So here's just a diagram of an ascending triangle. So the ascending triangle has, I guess, two characteristics. Number one, a significant resistance level where price is having a hard time breaking above that level. But at the same time, we're not seeing necessarily a straight line at support. That would be a rectangle, right? Where you have resistance, you have support, prices bouncing back and forth in between those levels and off of those levels. But it's a level of support. Now what we're seeing here is higher lows along with a resistance level. So that's potentially bullish. We don't trade anywhere within the triangle pattern thinking we're going to get in before the breakout, right? No. We trade the breakout. We wait for the breakout. We want to make sure that that breakout is above resistance, the closing price is above resistance on higher volume, and we enter the trade the following day. Okay? Make sure the price moves higher than the closing price of your breakout candle. The following day, you take the trade. Your initial stop loss, okay, pay attention here, it's the last touch of the lower trend line. Okay, it's the last retracement off of that lower trend line. You place it right below that low, right below the last retracement off of that lower trend line. There's your initial stop loss. And the measured move, let me go back a slide. It says the distance from the top to the bottom of the triangle. Now, there's different levels where you could begin your measurement. I don't like to go all the way back here, honestly. I mean, if I was super greedy, I probably would. And I don't like to go in between here, like right in this area here, measure that from resistance to this level here. I'll split the difference, honestly. So what, again, what we're doing is we're taking whatever this price is, subtract it from that price, and adding it to the closing price of the breakout candle, and that is your measured move. That is your initial profit target. Well, I don't have to take that difference there and add it, nor do I want to be all ultra conservative and take this price and add it. I will split the difference, and I'll show you guys on a chart exactly what I mean. I'll kind of go right in the middle. I take that price, subtract it from that price, and I'll add it to the breakout, the closing price of the breakout candle. Okay? All right, so here's HELE. So here's an example of an ascending triangle. We had the COVID crash, right? We had the COVID crash, lower highs, lower lows. Then you had this nice rally, right? You had the nice rally. Look at the volume that accompanied that rally, okay? Price retreats, doesn't test the low, right? A couple of dojis here, and then the price rallies again. It fails to make a new high. Fails to make a new high, price retreats again. We don't go all the way back to test the higher low, right? We establish essentially another higher low before price rallies to resistance again. Look at what's happening to volume during that period. See how volume is drying up, lower than average. The orange line there, that's a 50-day moving average of volume. You have lower than average volume during this period of consolidation, and then you get your breakout. Then you get your breakout. You get your close above resistance on just a little bit better than a higher than average volume there. Okay, and there is your trigger candle. The following day you get confirmation. I know we didn't get closing confirmation, but you didn't know that at 9:45, 10 o'clock. Very likely early on in the session, price was above your confirmation level, so you took the trade. And my stop loss is going to be right in this area here. See the last touch, the last retest of this lower trend line here is where I would put my initial stop loss. I'm going to calculate what percentage loss that might be, because let's just say, really quick with the math, I got a $100,000 portfolio. I want to buy 5 stocks. I'm going to put $20,000 into each. I want to put $20,000 into each position, right? I don't want to risk any more than 1% of my overall portfolio value on any one of those positions. So what's 1% of 100,000? It's $1,000. I don't want to risk any more than $1,000 on any one position. What's 1,000 into 20,000? It's 5%, right? So I'm not losing more, and I'm setting a stop loss at 5% on each position. Well, if this exceeds that, you have to adjust your position size. Let's say this is 10%. Let's just say. So from your entry to your initial stop loss, that's a potential 10% loss. Well, boy, if you put $20,000 into that position, you could potentially lose $2,000. That's 2% of your overall portfolio value. That's not where you want to be. So what do? You just cut the position in half. You could still trade the pattern, trade the breakout. You cut the position in half, put $10,000 into the position, so that if you do lose that 10%, it's still only $1,000. It's still only $1,000. You're keeping in line with your 1% rule. So I wouldn't measure it from here, guys. I wouldn't measure my measured move from here. I would kind of go right in between. Right in between. I'd take that price, I'd subtract it from that price, I'd add it to the closing price of the breakout candle. Didn't get there, but then what do we have here, guys? We have this bull pattern, a bull flag pattern that's happening again. All right, so somewhere at least in this area here is where I would exit the trade. Why? Because there's the breakout. Trade started off great. Volume was picking up, although over these last couple of days here, lower than the days before. But then you get into this consolidation period. Remember, you're in the trade off of the breakout here above resistance. Now you're into this period of really low volume consolidation. You take your trade off. Okay, here's TREK. So there's your nice up move. Okay, and there's your nice rally after this downtrend. Retreat off of this high here. We don't test the lows, but we rally and establish a higher low. We don't break out during this rally here. In fact, we actually retreat and establish now a resistance level right here. We retreat again. We don't test the recent swing low. We in fact make create another higher swing low. We rally to resistance again. Okay, and there's your breakout. There's your breakout. Okay. Breakout occurred on pretty good volume here. There's your volume day. Nice big tall green bar there. There's your breakout. There's your follow through or confirmation the next day. There's two ways to trade an ascending triangle. There, and I'm teaching you the first way. It's trading the breakout. You wait for the breakout. You enter the trade the following day on confirmation. The second way to trade it, initially and or to add to the position that you took off of the breakout, is to wait for the retest of support. A lot of times you'll see that. You'll see the breakout. You'll get a nice breakout on good volume, but then you'll get a retest. Remember, this is resistance. When resistance is broken, sometimes you will see a rather imminent or immediate, retest of that support level. So if you do take the trade on the breakout, okay, and it comes back to retest support and then retraces from that support level, you can add to the position. Okay, you can add to the position. Or if you don't trade the breakout and you wait for the retest, you can take on the initial trade or the initial position off of the retest off of that support level. All right. So here's another example, CDE. There's your low, there's your rally, there's your retreat, there's your rally again. We're establishing strong resistance in that level, strong resistance at that level. Okay? Higher lows, there's your breakout. Okay? There's your breakout. Following day, you get confirmation. You set your initial stop loss right below the low of the consolidation period. I wouldn't measure it from here. I wouldn't measure it from here. I'd probably go right to here, right to this area here. Again, not being too greedy, but not being too conservative. Okay, so I'd take that price, I'd subtract it from that price, I'd add it to the closing price of the breakout candle, and there is your measured move. That's where your initial profit target should be. Okay, knowing very well you might not get there, just depending on, you know, how big of a how wide of an area this is. But if you have, again, 10% profit, don't lose more than half of that. And then again, if stochastics goes above 80, you're looking at an overbought situation. Maybe look for some bearish candlestick formations. Okay. All right. I'm going to hop into the program here. Let me show you guys a couple of trades that I've had on my radar recently. And those of you guys that are in our swing trading coaching group know. I'm looking for a breakout here with ZIM. All right. ZIM integrated. What type of pattern is this? This is as of, guys, this is the hard right edge now. Not a flag. Not a flag. Although it might look like a flag. But this is as of the hard right edge, actually the close of today. This is an ascending triangle. Level of resistance at $47.25. I mean, almost to the penny there with 3 touches. Are we seeing support here? Yes and no. You know, it is support, sure, but we're not seeing retreats that fall back to this $33 and change level. What I'm seeing, higher lows, connect the lows, higher low, higher low, higher low. You know, just a couple of days ago, guys, I was hoping for this breakout. In fact, last Thursday was our swing trading coaching group on the 10th. Here was the 10th. There was the day that I put this stock on everybody's radar and I put this stock on a watch list. I was hoping for a breakout. We never got it. We got another retest of resistance, another retracement. Got a nice day today. Hopefully this is a sign of you know, better days ahead here and a nice breakout shortly. But we got another retracement off of this lower trend line. Okay, so I will wait. I'll keep this in a watch list. I will wait for price to go above 47.25, closing nicely above it on really strong volume, and then I will enter the trade the following day. If the stock price goes higher than the close of the breakout candle, my initial stop loss, let me draw it here, is going to be right below the last retest of this lower trend line. Okay, now where would I measure my move? I'd probably, you know, again, not too greedy. Probably measure it right there. From the first retest of resistance to the lower trend line there. John says, did you select the stock because of the technicals or was it fundamentals also used? Just strictly technicals. Strictly technical. Although, if you just throw earnings, we only have 4 months of data, guys, on this one, by the way. But if you throw earnings per share on, you got some fundamentals behind it. Earnings per share is $4.01, and it's steadily rising here over the last 4 months. Again, only 4 months of data. You're really a purely technical play. All right. Measured move. So I'd take this. I'd go, okay, what's the bottom of that? That's 37. We'll say 38 bucks to $47. That's $9. $9. I already know where my measured move is going to be. I'm just waiting for the breakout. So once price breaks above resistance, I'm going to add $9 to the closing price of that breakout candle. And if I get follow through the next day and I do take the trade, $9 from the closing price of the breakout candle is where my measured objective is, my initial profit target. Okay, and again, I know where my stop loss. I know where my stop loss is now, my initial stop loss, if we get a breakout here over the next couple of days. But if we don't, and we happen to hang out in resistance and time goes by and we happen to retest, it's hard because we're, guys, that's why it's called a wedge, right? It's another form of a wedge, because you can see how price is getting squeezed in tighter and tighter. Something's got to give here, right? Something's got to give. I mean, we can't stay in this pattern forever. You're either going to get a breakout or a breakdown. We hope in this case for a breakout so we can trade it. Yeah, these are daily charts, David, yes. And we don't, Nick, I said this earlier, this is a cherry picking technique, cherry picking strategy. There's no scan within the VectorVest program to find anything that I'm teaching you guys here today. And that's fine. Look, if one of the things I try to do, every day when I give these webinars or teach any course, I want to make you guys better traders. The best traders know how to read charts, right? So this is an exercise in that. It's an exercise in understanding how to read charts. Scans are great. I love scans. Trust me. I have scans for a lot of the different techniques that I'll teach in various different courses. And I always say this, the scans get me most of the way there. I have to still look at the charts. All right. This is an ideal ascending triangle pattern. Ideal. We're working off our third retest of resistance and nothing but higher low after higher low. I mean, it's just textbook. It's a textbook ascending triangle. Same thing with TMST. This is another stock I brought up to the group last week. Same thing, ascending triangle. Resistance. There's one touch. There's two touches. We didn't quite get a breakout, did we? I mean, intraday we did on June 14th, but boy, we sold off sharply on that day, right? Whoops, I don't want to draw that kind of line. I want to draw an extended line. Just going to connect our lows here. Going to connect our lows. We're right there still. Not, look, it's not textbook. We're still right there. We're still in the pattern. The last couple of days, right? The last couple of days low did not fall below the last retest of this uptrend line. Okay? So we're still in the pattern. Look, if price continues to break down and falls below the low, this last low, $13.61. If price continues to fall and breaks down below that low, then I think this pattern is invalid now. Okay, because we wouldn't be seeing higher lows anymore. So Nick says low volume. Look, it's hard to tell, guys. Well, that you want low volume. Number one, you see this big volume bar? It throws everything else off. Let me just zoom in here. Okay. So for the most part, you do want low volume, right? As time goes by and as price gets squeezed in tighter and tighter and consolidates for longer and longer period, you want to see that lower than average volume. Now, we've seen big redwoods, right? These big volume bars over the last couple of days, low today. So we'll see what happens over the next couple of days. Remember, we're not trading this setup here. We're waiting for the breakout. All right, so yeah, sure, sell-offs over the last 2 days there on high volume, that's not encouraging. But we're not going to throw the trade away just yet. We're going to keep our eye on it. And then finally, OAS. This is a trade that I did take. Okay, in our swing trading coaching group. I'll talk a little bit about that in a moment. But as of June 10th, which was last Thursday, what is this pattern, guys? This is a bull flag, isn't it? This is a bull flag. So here's where I would measure my flagpole. I don't have to go all the way down to the bottom here. Okay, that nice breakout day, I'll start at the close, I'll end at the close at the top. That's my flagpole. Period of consolidation. Okay, I'm going to try to connect more points here, right? More price points, and just you could see it's clear consolidation. The volume drying up, lower than average, and there were some times during the up move where you had a higher than average volume. Number of days there higher than average volume. Okay, we got our breakout. On June 14th. Not quite that day. That really wasn't the breakout day, but on June 14th, we got a clear breakout above resistance on really good volume there. Okay? So I took the trade the following day on June 15th. Price went higher, and I took it as soon as it went above the closing price of the breakout candle. Dan says, put in a buy order just above the top gold line. If you put a buy order in at just above the top gold line, it's going to fill immediately. And that's not how you trade the pattern, because you want to wait for the price to close above the gold line. I've seen a lot of times where price rises above resistance during the day, but then retreats back within the channel at the end of the day. You would have taken the trade if you placed that order right above the gold line, because on an intraday basis it filled, right? So the textbook, and guys, you could do whatever you want. And I understand. Look, if I look at some examples and say, man, I should have traded as soon as it went up above resistance, but you just don't know that. You got to wait for the close above that consolidation period. That shows you a true breakout, and that an intraday breakout doesn't. Okay, so there's the day I entered the trade. Price went above 97 bucks. It went above it actually opened above 97 bucks and then continued to move higher. So I took the trade. I set my initial stop loss. Whoops. Right below the low of the consolidation period, and I sized my position accordingly as well. I calculated what that would be. I just don't remember off the top of my head exactly where it was, but it was right below the low of the consolidation period. I think it was like 89 and change. I calculated what that max loss would be. I think it was about 8%, so I had to adjust my position size accordingly. So I put a little less money into the trade. All right, and we moved a little higher today, a little doji today, but my profit target hasn't been reached yet. Okay, because I'm subtracting 77 bucks, 95 bucks. That's I think it was an $18 profit target from what I remember. So I added that to the closing price of the breakout candle, and that's where my initial profit objective is. Dan is asking, does the doji scare you? I wouldn't use that word. Little concerning. Okay, little concerning that I have a doji here. Look, remember, after a breakout above the flag, the consolidation period, the resistance level, we might see a retest of it. We might still see a retest because it is essentially resistance that we just broke out of. We may see a retest of it. I hate to come back all the way back into the consolidation period, but I have my stop loss in place if that happens. Okay. James says, what list is used to determine stocks you look for flags and triangles? Any list. Any list. I have watch lists that I've created. I can look at the S&P 500 watch list, the Dow watch list, the top VST stocks, any list of stocks, you can look for breakout patterns like this. Okay. Yes, Glenn, I would move my stop up as the stock goes my way. Absolutely. Again, if I make 10%, I don't want to give back half of it. If I get halfway, to my profit target, then I will raise my stop up, so at least that I'm not I can't lose on the trade. So maybe I'll raise it to entry, okay, so that I can't lose on it. If the stock goes my way, I'm not going to keep. Whoops, I'm not going to keep. Not going to keep that initial stop loss all the way down there. Yes, so I entered on the 15th, correct, Nick? Breakout was on the 14th. Next day, I entered. Okay. All right, guys, let me just, I want to thank you guys for joining me here today. I really appreciate it. I'm just going to spend a few minutes. If you're interested in learning more about different types of chart patterns, I talked to you guys about triangles and flags. What I want to talk to you guys now about is a new course, not a new course, we've done this course before. Steve Chappell, myself, Dr. David Paul, we teach a course called Precision Swing Trading. We'll talk about reversal patterns, as you can see, double tops and bottoms, head and shoulders, inverse head and shoulders. In Module 3, we teach different types of technical indicators, ADX, RSI, stochastic support and resistance. Those are indicators for channeling markets. We teach you indicators for trending markets, MACD, moving averages. Steve does a great job with this module. How to draw trend lines, how to adjust your trend lines. Okay, more on the Midas touch as well. All right, and then what I love about, and then we'll teach you more. I come in Module 5 and add to what I taught you here today. Rectangles and pennants. Pennants are a form, is a form of a flag pattern. And also in the triangle segment of this, I'll teach you about descending triangles and symmetrical triangles as well, and how to trade those. And then Module 6 is my favorite one. We wrap everything up and we go through how to set up these trades, how to execute, and how to manage. Okay, so here are a couple of bonuses. Joe, you're reading my mind. Here are a couple of bonuses. So when you register for the course, and I'll talk about that in a moment, you're going to get, if you don't already have it, you will get 60 days access to the VectorVest Premium program. This is our real-time data, which includes ProTrader, the Auto Timer, and the Watchdog. Your trial here, if you don't already have VectorVest Premium, it will begin on June 30th. That is the first week of our first mastery session that we will be giving. Okay, I'll talk about that in a moment as well. All those modules, guys, that I just went through, those 6 modules, those are all pre-recorded, available as soon as you register. We're going to have 6 live mastery sessions as well. Now, another bonus is you're going to get access to our swing trading coaching group. So Joe asked, does this include the coaching group? It does. It gives you access to 6 swing trading sessions. They will begin the same week that we begin our first mastery session as well. Same week your trial begins if you don't already have VectorVest Premium. So I talked about OAS, right? A trade that I placed in our swing trading coaching group. We manage a portfolio in that group, okay? And we teach you in this swing trading coaching group. I'll highlight on a weekly basis. I'm the lead facilitator of the group. We'll have Dr. David Paul come in. We'll have Steve Chappell come in. We'll have Stan Heller come in and do a segment. But I'll teach different techniques that we'll teach in any of our other courses. For example, RSI 2 or the 50-50. Those are 2 swing trading techniques that I'll teach in our Trade Like a Pro course. I'll highlight those and teach those in this group. So it's a great group. Everybody kind of contributes, and everybody learns a lot about the different swing trading techniques that are available. Okay, here are the dates for the live mastery sessions. They will begin on July 6th. Okay, they'll begin on July 6th. Tuesdays at 2 p.m. Eastern Time. Now, what I want John to do, and I want to thank John for being here. I want him to go to www. I want him actually to write in the, there, he did it already. Thanks, John. www.vectorvest.com/PST. If you click on the link that John put in the chat box, it'll take you right to the registration page. All right. Once you register, you will have access to all of the content. You will have access to all of the core modules that are pre-recorded. You will also have access to the old mastery sessions that Steve, David, and I did a few months back. Those mastery sessions that are currently in the university that you can watch now will be replaced by yours, by these that we do starting July 6th. Okay, then we're going to do a bonus module on Tuesday, August 17th. That's the day after our last mastery session. And that session will begin at 2. It's called How to Short Stocks with Confidence. Okay, so normally the rate for this course is $9.95. We do have a Father's Day special going on, and it's going on to the end of the month. We're going to knock the price in half, $495. You just have to go to www.vectorvest.com/PST. This is the lowest rate we ever offer for this course. www.vectorvest.com/PST, and you go ahead and register. Click on Purchase Course Now, and then you're on your way. $495, Jay, not $4.95. And thanks for the reminders, guys. Just give me a moment while I upload today's slides to your handout section of your GoToMeeting control panel. Just give me a moment to do that, and I want to thank everybody for sticking around. All right, give me one moment. I think it's easier for me to do it this way. All right, you guys should see it in a moment. I just dropped it into the handout section of your GoToMeeting control panel, and it should be there now. You should see it there now. Okay, I'm going to stick around just for a few more minutes, guys, if you have any questions. So David's asking, can you repeat or show where to get the slides? David, do you see them now? It says Precision Swing Trading Sneak Peek, and that is the PDF of the slides that I used here today. Yes, Nick, you will get today's recording. You'll get actually a recording of all of the presentations that we were doing this week for our Father's Day special. There'll be a page where all the recordings will be stored, but you will get a recording as well, a link to the recording sometime this evening. You're welcome, Dave. I appreciate that. So Sherilyn, they won't be emailed to you, but again, you can access them and just click on that PDF that I inserted into the handout section of your GoToMeeting control panel. Dana says it's a great course. David, Paul, Steve, and yourself are great. Thanks, Jerry. You're welcome, Dana. Appreciate that. You're welcome, Alp. Thank you very much. Look, guys, anybody, if this is a course that you haven't taken before and you're registering now, or you're planning on registering, type in "I'm in." Just type in "I'm in" the chat box. I always like to kind of see the name of a future student and you know, kind of recognize that name once we begin. Ed says, "I'm in." Welcome aboard, Ed. Awesome. Sherilyn says, "Planning on it." Don't forget, guys, if you don't have the VectorVest Premium package, that's our real-time program. You're going to get 60 days access of that. You're also going to get access to our 6 coaching groups, 6 sessions of our coaching group. That'll begin the first week of the mastery session. Wow, awesome. James says, "I'm in." Stavros says, "Amen." G says, "I'm in. However, please answer my question above." I'm looking at it. Okay. What are the main differences between swing trading course and a successful investor 6 weeks to steady growth? Good question. Swing trading course, primarily technical analysis trading. We're holding positions for a few days, maybe a few weeks. The successful investor 6-week course is more of investing strategies, looking at fundamental valuation as more so than technical analysis. Okay, it's core VectorVest really at its basic. Okay, so it's more of an investment course. This is more of a trader's course, G. So I hope I answered that correctly. Okay. All right, you're welcome, guys. Awesome. I look forward to working with you. Look, my email address, write it down, guys. Grab a pen real quick. My email address is jerryd, Jerry, D as in David, @vectorvest.com. Shoot me an email if you have any questions about anything that I talked about today. And again, we begin, once you register for the course, you're going to get an email with all the instructions you need moving forward, the dates of our mastery sessions, how to access the university right away, where you can watch all the content there. before we start our first mastery session. Again, that'll be on June 30th. Okay. Michael, shoot me that email again. I didn't see that email. Shoot me that email again, and I'll definitely answer you within the next day or so. All right. All right, guys. Have a great rest of your evening. If I don't talk to anybody before Friday, have a great weekend, and we'll see everybody soon.